Financial Reporting Through the Lens of a Property Casualty Actuary. Chapter 19, Part 6, R4. The RBC Charge for Reserve Risk, R4. R4 is very often the largest of the RBC charges for property casualty insurers. Reserve risk contemplates the risk that a reporting entity's loss and LAE reserves will develop adversely. This charge is calculated separately by line of business using Schedule P data for the last 10 years. R4 is the charge for reserve risk associated with the following. 1. Unpaid loss and LAE, reserve RBC. 2. Excessive premium growth. 3. Reinsurance recoverable, reinsurance RBC. 4. Accident health, or A&H, claim reserves, health RBC. Within the following sections, we provide a discussion of each of these categories with considerable focus on the reserve RBC, since this represents the dominant component of the R4 charge. Reserve RBC. Reserve RBC is determined by applying a set of factors, called company RBC percent, to the company's net loss and LAE reserves before non-tabular discount. Nominal, or undiscounted reserves, are used because consideration for investment income is made by applying the same set of discount factors to all property casualty insurance companies, called the adjustment for investment income. The use of a common method for considering investment income puts all property casualty companies on an equivalent basis rather than having differences due to discount rates and payout patterns. The calculation is performed separately by line of business using the same lines of business as used in Schedule P of the annual statement, with the exception that certain lines of business are combined. The occurrence and claims made categories are combined for other liability and product liability, and reinsurance, property, and financial lines are combined. Once the calculation of the base loss and LAE reserve RBC is performed for each line of business, two adjustments are made. One for loss-sensitive, e.g. retrospectively rated, contracts, and the other for loss concentration. Similar to the asset concentration factor in R1 and R2, the loss concentration factor considers diversification in the RBC calculation. Both adjustments result in reductions to the reserve RBC. We will discuss each component of the calculation, providing examples where applicable. Base loss and LAE reserve RBC by line of business. The base loss and LAE reserve RBC by line of business is computed as follows. Equation 1. Base loss and LAE reserve RBC equals the sum of company RBC percent plus 1 multiplied by the adjustment for investment income, then minus 1. All of that multiplied by the sum of net loss and LAE reserve and other discounts not in the reserves. The net loss and LAE reserves used in this calculation are provided in Schedule P, Part 1, Column 24 for each line of business. As previously noted, these are gross of non-tabular discount, but net of tabular discount. Company RBC percentage. The company RBC percentage is the crux of the reserve risk charge. According to the NAIC RBC instructions, these factors are designed to provide a surplus cushion against adverse reserve development. For each line of business, the company RBC percentage is determined based on a 50% weighting applied to the straight industry reserve RBC percent and 50% applied to the industry reserve RBC percent, adjusted for the company's own experience. Industry reserve RBC percent. The industry reserve RBC percent is a set of factors provided by the NAIC and is the same for all property casualty insurance companies. There is one factor for each Schedule P line of business. According to the NAIC RBC instructions, these percentages are based on detailed analysis of historical reserve development patterns found in Parts 2 and 3 of Schedule P for each major line of business. They have been determined in the past by computing the ratio of net incurred loss and defense and cost containment (DCC) development during a particular period from Schedule P Part 2 to the net loss and DCC reserves as of the earlier period, calculated by subtracting the figures in Schedule P Part 3 from those in Part 2. The industry percent factor is selected based on the average for all companies within the property casualty insurance industry by line of business. The industry RBC percent factors are not always updated annually, but rather on an as-needed basis. In fact, the factors in the original RBC model remained for well over 10 years. The only interim change was made to reflect the change in the format of Schedule P, such as when medical malpractice was split into the claims made and occurrence components. The NAIC developed the original factors in 1993 based on an actuarial analysis using data evaluated as of 1991 and prior. This analysis computed the aforementioned ratios of incurred loss and DCC to prior period reserves over each evaluation period, provided in Schedule P, Parts 2 and 3 of the 1991 Annual Statement. 9 ratios were computed, the first of which provided development on accident years 1982 and prior over the period December 31, 1982 through December 31, 1999, as a ratio to loss and DCC reserves as of December 31, 1982. The remaining 8 ratios were computed measuring development to December 31, 1991 for periods beginning December 31, 1983 through December 31, 1990. The 9 ratios were calculated for each line of business by company. An average was computed over all companies for each evaluation period. The industry RBC percent factor for each line of business was set equal to the largest ratio over all of the evaluation dates. This is commonly referred to as the worst-case year ratio. The belief is that development of this magnitude could occur in the future because it occurred in the past. The original factors remained until 2008, when the NAIC adopted changes recommended by the American Academy of Actuaries P&C Risk-Based Capital Committee, or Committee, in a report titled An Update to P&C Risk-Based Capital Underwriting Factors. September 2007 report to the National Association of Insurance Commissioners P&C Risk-Based Capital Working Group. In this study, the committee recognized that the insurance industry had been through many changes since the original factors were developed, namely changes in the underwriting cycle resulting in shifts in reserve redundancies and deficiencies. Furthermore, despite the formulaic approach of the worst-case year, the committee found that the original factors could not easily replicated and varied considerably relative to expectations as to the level of adverse development inherent in a particular line of business. The committee therefore recommended developing a revised approach that would meet the following criteria. 1. Simple to apply and understand. 2. Responsive to actual history and underlying risk. 3. Easily reproducible by future practitioners. 4. Statistically relevant. 5. Resulting in indications that could be adopted without disruptive swings in required capital for regulated companies. The revised approach differed from the original approach in 4 significant ways. 1. The historical data was filtered and screened to remove companies with insufficient or unusual data points. Examples include companies with less than 10 years of experience and/or companies with negative paid, reserve, and/or incurred loss and DCC in any one accident year. 2. Rather than selecting the ratio from the worst-case year over the average of all companies, the 87.5 percentile of all data points was used. The 87.5 percentile was selected because it represents a conservative view of the risk in each line, but is also broadly consistent with the existing factors. 3. A floor was set such that the indicated industry reserve RBC percent factor resulted in a minimum charge of 5% after adjustment for investment income. 4. The indicated industry reserve RBC percent factors were capped to limit the change in the base loss and LAE reserve RBC. The committee recommended a cap of 35%. For example, the indicated industry reserve RBC factor for private passenger automobile liability that was produced using the revised methodology before capping was 0.128, and the change in the investment income adjustment factor was 0.927. Using equation 1, assuming a net loss and LAE reserve balance of $1, the implied base loss and LAE reserve RBC is 0.046. As displayed below, this represented a change of minus 70.5% from the original industry reserve RBC factor of 0.254, with adjustment for investment income of 0.921. Indicated base loss and LAE reserve RBC based on 2007 methodology before capping equals 0.128 plus 1, all multiplied by 0.927, then subtracting 1. All of that times $1 comes out to 0.046, whereas the original base loss and LAE reserve RBC is 0.254 plus 1, all multiplied by 0.921, then all of that minus 1, and multiplied by 1, which worked out to 0.155. Change in base loss and LAE reserve RBC from original to the revised 2007 methodology is 0.046 over 0.155, all of that minus 1, which works out to minus 70.5%. Capped at 35%, the revised methodology produced an industry reserve RBC percent factor of 0.187, which was calculated as follows. Quantity 1 minus 0.35 quantity times 0.155, all of that plus 1. Then divide all of that by 0.927 and take that quotient and subtract 1, and you get 0.187. To summarize, the industry RBC reserve factor indicated from the revised 2007 methodology was 0.128 before capping and 0.187 after the 35% cap. The 35% cap reduced the impact of the change in methodology from the original factor of 0.254. The NAIC adopted the factors in 2008 using the revised methodology and indications of the September 2007 report. However, with a cap at 15% instead of 35%. The revised factors were applied to RBC calculations for the 2008 reporting year. To continue with the previous example, capping at 15% resulted in an industry RBC reserve percent factor of 0.221, which was calculated as follows. Quantity 1 minus 0.15 quantity times 0.155, all of that plus 1, and then divide all of that by 0.927, and then subtract from all of that 1, which comes out to 0.221. Subsequent changes to the industry reserve RBC percent factors were also made and adopted in 2009 and 2010. The 2009 update applied a 15% cap to the factors adopted in 2008. That is, 2008 factors were substituted in for the original factors in the previous calculations, for purposes of capping the impact from the effects of the 2007 revised methodology. This revision was adopted in 2009 and applied to the 2009 reporting year. Two changes were made in 2010. First, in March 2010, the American Academy of Actuaries P&C Risk-Based Capital Working Group updated the 2007 methodology, but with 2008 data. As with the 2007 study, the factors were capped to cause no more than a 15% charge to the more than a 15% change to the current factors, the 2009 updated factors, and the minimum charge was set at 5%. Second, in June 2010, the March 2010 study was updated using a 5% cap instead of 15%. The 2010 study, capped at 5%, was adopted and applied to the 2010 reporting year. The 2017 RBC formula had a further update to the industry RBC reserve factors, the first since 2010. This update was based on changes recommended by the American Academy of Actuaries P&C Risk-Based Capital Committee in a report titled 2016 Update to Property and Casualty Risk-Based Capital Underwriting Factors. This report proposed a new calibration based on data from annual statements 1997 through 2014 and calculates the 87.5 percentile subject to the following filtering. Survivorship. Include data points where, for a particular company and line of business, there is no net earned premium in the latest accident years. Line of business size. Exclude data points where, for a particular line of business, net earned premiums are less than the 15th percentile for that accident year or reserve year. Pooling. Combine data points from intercompany pool participants into a single pool-wide data point. Minor lines. Exclude data points where the net earned premium for the line of business represents a small portion of the company's total net earned premium. Years of line of business with net earned premium greater than 0. Exclude data points where, for a particular company and line of business, there is less than 5 years of net earned premium. Maturity. Remove the least mature data points. Anomalous values. Exclude data points with anomalous values, i.e., negative loss ratios, negative initial reserves, and reserve runoff ratios over or under 500 or minus 500%. In 2017, the NAIC's Property and Casualty Risk-Based Capital E Working Group updated the industry RBC reserve factors in the 2017 RBC formula to the 10% capped level, representing Scenario 1 in the report. The factors were due to be reevaluated again and expected to reach the fully proposed values in the following 4 years. In 2018, the NAIC's Property and Casualty Risk-Based Capital E Working Group further revised the factors to be included in the 2019 RBC formula by adopting the 35% capped factors, Scenario 3, for commercial insurance, medical professional liability, and all other lines, while adopting the uncapped factors, Scenario 4, for personal and reinsurance lines. Company Development Factor. The reporting entity's own loss experience is considered by adjusting the industry reserve RBC percent by the company development factor by line of business. This development factor is calculated as the ratio of the sum of incurred loss and DCC from 9 prior accident years, evaluated as of the current year, to the sum of the initial evaluations of those incurred amounts. The current incurred loss and DCC values come from Schedule P, Part 2, Column 10, with the initial values coming from the first incurred value shown for each accident year. The initial values lie along the diagonal. This development factor measures how the initial estimates of ultimate loss and DCC have developed based on what the company currently knows. The factor is capped at 400% to limit the impact of anomalous one-time results. The reporting entity may not rely on its own experience in determining the company RBC percentage if 1. Either the initial or current values shown in Schedule P Part 2 are negative for any year, 2. The current value is 0 for any year, 3. The sum of the initial values is 0 across all years. Adjustment for investment income. With the exception of workers' compensation tabular reserves and instances where a company has explicitly requested and received permission from state regulatory authorities to discount non-tabular reserves, insurance companies are required to record loss and LAE reserves on an undiscounted basis under statutory accounting. This creates an inherent margin in surplus. For purposes of determining required capital under the RBC calculation, the reserves are adjusted to remove this margin. Similar to the industry reserve RBC percent, the investment income factors are provided by the NAIC. According to the NAIC RBC instructions, this discount factor assumes a 5% interest rate. For lines of business other than workers' compensation and the excess reinsurance lines, the payment pattern is determined using an IRS-type methodology applied to industry-wide Schedule P data by line of business. Otherwise, a curve has been fit to the data to estimate the average payout over time. The discount factor for workers' compensation is adjusted to reflect the tabular portion of the reserves that is already discounted. Tabular discounting is typically permitted only in the indemnity portion of workers' compensation reserves, and not to the medical component, due to the relatively fast payment of medical expenses. Similar to the industry reserve RBC percent, the investment income adjustment factors were updated in September 2007 from their original values. An approach similar to the original methodology was followed, but applied to updated data through 2005. Other discounts not included in the reserves. The adjustment for investment income is applied to reflect non-tabular discount. It is applied to loss and LAE reserves on a net of reinsurance basis, net of tabular discount, but before any non-tabular discount, as provided in column 24 of Schedule P, Part 1. If for some reason the amounts included in column 24 are net of non-tabular discount, the amount of the non-tabular discount would need to be added back to the reserves before applying the adjustment for investment income. These amounts are generally equal to 0. The amount of non-tabular discount is included in columns 32 and 33 of Schedule P, Part 1. Adjustment for loss-sensitive business. Prior to summing the reserve risk charge over all lines of business written by the reporting company, an adjustment is made to reflect loss-sensitive business. The loss-sensitive adjustment provides a discount for business that is written by the insurance company on contracts for which the premium is determined based on the insured's loss experience, i.e., retrospectively rated contracts. The loss experience is shared in whole or in part with the insured. Therefore, the risk of adverse loss development is also shared with the insured. The insured needs less surplus. The insurer needs less surplus to survive this risk of adverse loss development than it does if none of the policies were written on a loss-sensitive basis, thereby resulting in a discount to the company's RBC reserve charge to reflect this reduction in risk. This discount is computed separately by line of business. The following provides the application of the loss-sensitive adjustment. Equation 2, loss and LAE RBC after discount, equals equation 1 minus the loss-sensitive discount, which equals the base loss and LAE reserve RBC minus the loss-sensitive discount, where the loss-sensitive discount equals the loss-sensitive discount factor times the base loss and LAE RBC from equation 1. The loss-sensitive discount factor is 30% for net loss and expense reserves associated with direct loss-sensitive contracts, and 15% for net loss and expense reserves associated with assumed loss-sensitive contracts. The difference stems from the potential offset associated with reinsurance contracts for commissions that are loss-sensitive as well. Oftentimes, such business is written with sliding scale commissions, whereby the commission the ceding company receives from the reinsurer, is dependent upon the loss ratio of the business. The lower the loss ratio, the higher the commission paid by the reinsurer to the ceding company, subject, of course, to specified limits. For example, the reinsurer may receive additional premium from the reinsured as losses emerge, but in turn have to pay additional commission due to a reduction in loss ratio. As with direct loss-sensitive contracts, the risk of adverse loss development on assumed contracts is reduced. However, it is not reduced by as much due to the potential offset from ceding commissions. The portion of net loss and expense reserves attributed to direct and assumed loss-sensitive contracts is found in column 3 of Schedule P, Parts 7A and 7B, respectively. Adjustment for loss concentration. The loss concentration adjustment is applied to the sum of the RBC reserve charges for all lines of business and reflects diversification across the lines. The theory underlying this discount is that the reserves for each line of business written by an insurance company would not be expected to develop adversely or favorably at the same time, assuming such development is random. The final net loss and LAE RBC charge is computed as follows. Equation 3 is the net loss and LAE RBC, which equals total loss and LAE RBC after discount for all RBC lines, multiplied by 1,000, multiplied by the loss concentration factor, where the loss concentration factor is the net loss and LAE for the largest line times 0.3 divided by the net loss and LAE for all lines combined, and then add 0.7. The loss concentration factor is determined by taking the percentage of total net loss and LAE reserves for the largest line of business to the total net loss and LAE for all RBC lines combined, multiplying this percentage by 0.3 and then adding the result to 0.7. Because all adverse loss development may not always be a random fluctuation in losses, such as when the company increases loss reserves to improve its earning position, adverse development across lines may not be totally independent. This formula recognizes that there may be some interdependence between lines of business. A monoline writer would not receive any discount, as the calculation would be 1 times 0.3 plus 0.7, which produces a loss concentration factor of 1. However, a company writing 60% of its business in its largest line would receive a discount to its reserve risk charge of 12%, or a loss concentration factor of 0.88, which is 0.6 times 0.3 plus 0.7. Illustration of reserve RBC calculation. The following provides an illustration of the reserve RBC calculation for a REIC. Assume REIC writes only 4 lines of business: homeowners, farm owners, HOFO, private passenger automobile liability, PPAL, workers' compensation, WC, and other liability, OL. The source of the company's own data is Schedule P, which is provided in thousands of US dollars. As displayed in Table 88, the reserve RBC included in the R4 charge for REIC is 6,948,010. The main driver of the reserve RBC is the company RBC percentage for loss and LAE reserve risk. This percentage is higher than the industry RBC percent in line 3 because REIC's ultimate estimates tend to develop adversely, as evidenced by the ratios of company development to industry development in excess of 1 in line 8 above. Table 89 provides another example of the detailed R4 calculation for the commercial automobile liability CAL line of business for a fictitious insurance company. This calculation uses the financial statements and Schedule P line detail found in other examples within this publication. Excessive premium growth. The estimation of unpaid loss and LAE reserves is subject to greater uncertainty for companies that are growing rapidly. The reasons are twofold. First, an insurance company does not have as much insight into new business as it does into risks that are currently on the books. Second, the estimation of unpaid claims is more difficult for a growing company rather than a company in a steady state. Consider a company that decides to grow its writings by 20% over the course of a year. As a company grows throughout the year, the average writings are more heavily skewed towards the second half of the policy year. Without explicit consideration for this shift, traditional actuarial projection techniques will not adequately capture the lag in loss emergence and therefore will understate the reserve need. However, the difficulty is in determining how exactly to consider this shift. In the RBC calculation, excessive growth is defined as a 3-year average growth rate in gross written premiums that is in excess of 10%. A growth rate of 10% is deemed to be a normal annual increase in premium volume. The growth rate for any single year is capped at 40%. The excess percentage, excess of 10%, is called the RBC average growth rate factor. The average growth rate factor equals the maximum of the average gross premium growth over 3 years, or 10% minus 10%. For purposes of this calculation, gross written premiums are equal to direct written premiums from line 35 of column 1 of the Underwriting and Investment Exhibit, U and IE, plus assumed premiums from non-affiliates in column 3. To perform this calculation, Part 1 of the U and IE is required for each of the past 4 years. The calculation is performed using as many years as possible, but no more than 4. If the company only has 1 year of experience, only 1 year is used. However, if the company is a startup, a growth rate of 40% is used. If a company has no gross written premium in the current year, it is assumed not to be growing and a growth rate of 0 is used. This calculation is performed on a group basis for those companies that are part of a group. Therefore, each member of the group will have the same RBC average growth rate factor. The group basis is used to neither punish nor reward individual legal entities that might be growing due to a realignment of business from one company within the group to another. In this case, the growth is not attributed to new business, but rather a transfer of risks from one company to the other. In addition, business acquired or divested as a shell is included in the calculation of the growth rate only to the extent that the liabilities are retained by the reporting entity. Servicing carriers for assigned risk pools can also exclude the written premiums associated with the involuntary pool, as the insurer has little or no control over the assignment of such risk. The RBC average growth rate factor is multiplied by 0.45 of the net loss and LAE reserves as per the total line in Schedule P, Part 1, Summary, Column 24. Excessive premium growth charge for loss and LAE reserves equals the RBC average growth rate factor times 0.45 times the net loss and LAE reserves. The 0.45 has remained unchanged since the original RBC formula for property casualty insurers was implemented. It was determined by a member of the American Academy of Actuaries RBC Task Force, Mr. Alan Kaufman, after studying the average development in net loss and LAE reserves experienced by companies that experienced growth in excess of 10% relative to development observed by the remainder of the industry. The 0.45 is already adjusted for discount using a factor of 0.9, which was what Kaufman approximated to be the average discount factor for all lines of business. Reinsurance RBC. Recall from our discussion of the R3 charge that reinsurance RBC represents the minimum amount of capital included in the RBC formula that would be needed to survive the risk of reinsurer default. The reinsurance RBC within R4 is equal to the other half of the reinsurance recoverable amount computed in R3, unless the reserve RBC is less than the RBC for non-invested assets, plus 1/2 of the RBC for reinsurance recoverables. If this is the case, the entire reinsurance RBC charge is included in R3, and the reinsurance RBC within R4 is 0. The reserve RBC limitation was put in place so the insurance company cannot diversify away a portion of its credit risk in situations where the company has limited net reserves. Health RBC. In addition to the charge for property casualty lines of business, a separate health RBC calculation is required for those property casualty insurers that have written 5% or more in accident and health premiums in any of the last 3 years. We will not go into the details of this formula, but note that the health RBC calculation is based on the RBC formula for life insurance. Table 90 provides the R4 calculation for fictitious.